All right. Good morning. Morning, everyone. Welcome once again to PU Prime's Academy. Uh, my name is Victor, and oh yeah, you've been having Victor take yourself before, no? Mm. So that means there's no difference, sir. The sounding does not matter. is the is the is the Victor first off? Uh, at least knowing that it's Victor Victor. Mm. All right. So both you people that are here physically and those that are with us spiritually, I'm sorry, online, I welcome everybody to this class. So as you all know, this is a continuum of what you have been doing before, right? I'm sure most of you here, if not everyone, you attended, was it Tuesday session? Yeah. So we'll just do a little bit of recap first before we continue for today. Let me move this out a bit or put it here. Okay, um, so what did you do the last time again? Yes, like something you learned the last time. Hmm? Yes. Was it last Thursday, last or this Tuesday? No, no. You know, we try to build on previous knowledge. Yes. But most of you were here on Tuesday. Okay, for beginner. Okay, so this is more like continuum of last week's Thursday, right? Okay. All right. That's fine. So we'll do a little bit of recap. But for the sake of those joining for the first time in analysis class, we'll just do some still recap to bring them up to speed. Um, you see this market that we are trading, the financial market. There is money here. Abi? Now, why are you trading? Why do you want to trade? Or why are you trading? You're welcome, sir. You're welcome. You're welcome. Malga, you are welcome. I like the way people dress, bling blings. Mm. Yes, sir. So why do you want to trade? Like, why do you want to enter this market to trade? What's in it for you? Is it? I wish people can see them. See the bling blings. Yes, that's the lifestyle. All right. So at the end of the day, it boils down to money, profit, money, whatever. I've met persons who will tell me, I want to have the experience. Eh, it's okay. You want to have the experience. I hope you know that experience can be one of two ways. Your experience can be good or it can be what? But at the end of the day, you need to learn, right? So we are in this market to make money. Now, before I get to question, let's just establish some foundation again about um, understanding analysis in the global financial market. So how do we do analysis? The market, the way we look at the market is not the market is represented as charts, right? As charts. So when you're looking at the market, you will see something like this. This is how you would be seeing the market, okay, usually. So all of these are represented by candlesticks. Meanwhile, there are different ways you can be seeing the movement of the market, not just candlesticks. There's candlesticks, there is your line graph, there's your histogram, and there's also your line graph. These are the three ways you can see the market movement. But the most popular of them is what? Is there anybody here that doesn't know these are candlesticks? So we know where to start from. If you don't know, okay, don't worry. You will know very soon. We will soon get to the point where you will know. Uh-huh. Now, is this like your first time? Very, very first time. Wow, okay. Okay. No, it's good. Even Jesus Christ had people of different levels in his teachings. So we'll try to carry everybody along as much as possible. So now the market is represented by this. So we need to understand what we are seeing here. Hence the need for analysis. All right. So we need to understand what we are seeing. That's why we need analysis. Now let's just quickly establish some of these things. So we have three or different types of market analysis. You can analyze the market in different ways. But the three most popular ways we have are, the first one is what? Technical analysis. Technical. And technical analysis has to do with the charts. Because to be honest, it's a bit technical. You need to apply some techniques. So technical analysis. Then we also have what? Fundamental analysis. And that one has to do with the news. There's one prevailing fundamental now that is moving the market. One news that comes up every day now. What's that? Are people not current? Uh-huh. So what's the latest? Anybody knows the latest? Yeah, I was thinking you would have wiped out these people since. That's what he promised to do. And those guys were ready. But all of a sudden, he just changed his mind. 2 hours to when he promised to, he changed his mind. Now, so news like that, obviously, it affects the market. It makes price to move, right? Now, for instance, let's bring it home. Remember when your president came to power? The very first day, he gave a speech, and there was a popular statement he made. He said, subsidy is what? Gone. That statement alone, did it affect price of certain product or not? In the next 3 hours, filling stations were filled up with people willing to buy fuel, right? And before you know, fuel moved from almost 200 per liter. By the following 2 weeks or so, it went up as high as 600, right? Now, fundamental, even before the subsidy was removed, there was already hike in price. That thing was not caused by the normal demand and supply. First, it was that fundamental that came that changed the course of action, right? Then the last one is what we call sentimental analysis. When they tell you are sentimental, what does it mean? Like, what's your opinion? When somebody says you are sentimental, what's your opinion? You're attaching emotion. It's only a lady that can answer this thing accurately. No offense, please. But yes, you are attaching. It does not necessarily mean that thing is true. You are being sentimental about this matter now, right? Now, in the market, how do we look at sentimental analysis? We just look at the overall psychological state of participants in the market. Okay, if I run into this hall now and I tell you, I start shouting fire, 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 what will be your next move? I just run in and shout fire. What will be your next move? How many persons will still be seated? I've affected your psychology, Abi. I've altered the course of things, right? Or let's say you are going, once you go out of the gate now, you are going all the way up. And I see a lot of persons going marching up. Let's say over 100 persons. I'll be like, where are you going? They say they are sharing money in that place there. So that's why we are all going up. And someone now comes to you and say, no, it's not there. It's the other way. What will happen? Some people will change direction. But there will still be people who will feel like, no, it's still up. Abi? Good. Now, in the market, there will always be buyers and there will always be, everybody cannot be doing the same thing. Where somebody wants to buy is where another person is willing to sell. And where somebody is willing to sell, another person is willing to buy. We can't have everybody being buyers at the same time. And you can't have everybody being sellers at the same time, right? But there is hardly an equilibrium in the market. What do I mean? Buyers and sellers, it's hard for them to be equal in the market. It's either buyers are slightly more than sellers, or sellers are more than buyers. And in some cases, buyers can be way more than sellers, or sellers way more than buyers. I don't know if you get my point. So when we are applying sentimental analysis to the market, we are trying to look at both buyers and sellers. Who is more in the market? Are we together? Who do I want to join? Because at every point, buyers are fighting sellers, and sellers are fighting the buyers. Now, it's not necessarily this type of fight. So in the market, we have the bulls and the bears, the buyers and sellers. So when we say fighting, it's just negotiation. I want to buy this at no, I want to sell this at 100K. You feel like, oh no. Why don't you sell it to me at 50, Abi? No, I can't sell it at 50. Okay, you know what? The least I can sell it is 90, Abi? What would the person that wants to buy do? From 50, you can say, okay, you know what? Let me give you 60, isn't it? Negotiation is going on. And during that period, price is doing, no, that's why price will never remain static. It's always dynamic, moving. It's because buyers and sellers are always contesting price. You know, they call it fight, but it's negotiation, right? So in that case now, one person will obviously win that battle, sentimental analysis. Lastly, let me describe it like this again. I like using various examples. Have you played this game before, tug of war? Where they will carry one long group. They will draw a line in the middle like this. Some persons will be here. Some will be there. Abi? And they, who can drag the other to their own side. Now imagine that I put buyers now. Let's say this side are buyers. And I put like 100 persons here. This side are sellers. I put like 30 persons here, right? And I draw a line in their middle. All things being equal, there's no giant among them. They are like almost equal strength. 100 buyers, 30 sellers. Who do you think will win this battle? Most likely. All things being equal. Who do you think will win? I'm not getting a response. Buyers, right? Good. So, sentimental analysis is, if you cannot beat them, you do what? You know that saying now? Then there's also a saying, join the bandwagon. Because if the psychological state of things is that more persons feel like price we buy is going to go up, less persons feel that price will sell, there is a higher probability that the more persons that feel it will buy will win that. So when we are doing sentimental analysis, we are trying to see who is more in the market so that we will join them. And that's how we make our profit. Are we getting the idea now? So you can either do technical using the chart, fundamental, you judge price movement based on the news, or sentimental, overall psychology of participants in the market. Who is more will most likely win the race, right? So these are the three analyses that we have. Now, let's look at what exactly is technical analysis. So I'll just read it, but I'll break it down. So it is the study of past, or let me say technical analysis is the study of price movement in a market, whereby traders make use of what? Make use of what? I'm not the only one here. Traders make use of what? Historic charts, patterns, and what? Indicators to, this is one of the most important. Whatever they are doing is to predict future direction in the market. That means you are using the past to predict the future. Let me give you an example of technical analysis. We are currently in April, Abi? April. Now, let's assume a bag of rice is about roughly 65,000 now, Abi? Abi, anybody has accurate idea? Bag of rice. Sir? Really? What kind of rice is that? No, I'm not talking about local rice. I'm talking about local rice. Now, let's say a bag of rice is 60,000 right now. by December, in fact, November, December, do you think a bag of rice should be the same 60,000? Should it be higher or should it be lower than 60? Higher. Why do you think it should be higher? There will be more demand during that period. How do you know there will be more demand during that period? It's a festive period. Is that the first time that there will be more demand for rice, November, December? Is that the first time it's going to be happening? No, it has been happening way before, isn't it? So, most of the time, if not 100%, but most of the time, during November, December, price of goods normally, especially food items, right? Basic food items usually increase due to the increased number of demand around that period because of the festive season. Hence, the price will go up, right? So you can use that experience to say confidently now that by December, price of rice will not be 60,000, it should be 70,000 and above. Are we together now? So we are using the past to judge the future, right? What if, okay, let's just keep it at that so that we'll be very fast. Now, so it's to predict future directions in the market. Now, it gives graphical representations of past and present performance of a market, which guides and informs traders about the potential future direction before entering the market. Basically, all of this is, the summary is you are using past experience to judge the future, right? So that is technical. But you are doing all that with graphical representation. So let's move further. Benefits of technical analysis. Why we do this technical analysis? It's good. It helps us to know when to enter the market, when to exit the market, where to buy and sell. It helps traders to know the characteristics of price movement in the market. So if you are doing technical analysis, it gives you an idea of how price usually moves. It gives you an idea of how price usually moves. Then it's being used by most successful traders making profitable decisions. So these are benefits. It gives you the future market direction. Now, when we are looking at price movement in the market, there are certain things we need to know. When you are doing technical analysis, certain things are very, very paramount. And they are very key, right? So the first thing you need to understand is what we call the what? The trend. Trend is very important, right? So a trend is a tendency for price to move in a particular over a period. That is trend, right? So what we do with trend, let me even ask, when I say something is trending now, what comes to your mind? When I say, something is trending now, what comes to your mind? Like, what do you think I mean? The headline, bar? Sir? Okay, this is what is trending. And for something to trend, it's not just one or two persons that know about it. It means that a lot of persons know about it. That's why we say it is trending, right? Good. So when it is trending, you can say it is visible to the blind. That even the blind can see it. And it is audible to the what? To the deaf. Even the deaf can hear it. So when something is trending, it's not hidden. Now, okay. So we have different types of trend. For instance, price is moving this direction, this direction, this direction. What is this trend? Uptrend, right? Price is doing this and this and this for a period of time. What's this trend? Downtrend, right? So if you are saying this one is a downtrend, now I hope you know you are wrong. But do you know that somebody can still tell me this is a downtrend? It's possible. No, it's possible. It's possible. Out of 100 persons, there might be 1 or 2 or 3 or even 5 persons that will say, are you sure that one is up? Okay. So it's not necessarily 100%, but it means that majority agree that this is the trend, right? Now, let me give you an example. If I say, for instance, let me start from something we can relate with. USD NGN. USD NGN. And you know this one, USD. Which currency is this one? Okay, your country's currency. This is good, right? Now, out of these two currencies, which one do you think is stronger? Is the prevailing currency? USD. So USD is the prevailing currency, right? That means if this is stronger, this one is strong or weak? So in this particular pair now, this is the stronger one, this is the weaker one. It means that $1 is equal to $1 is equal to how many naira, right? So let's say, you know, there was once upon a time that $1 was equal to 1 naira, even less. There was a time it was equal to 10 naira. At some point, 20, right? At some point, 50. $1 was equal to 70, was equal to 100, was equal to 500, equal to 1,000. There was even a time it was equal to 19, right? Let me put 15 here first. 1,500, 1,900. This is about 1,900 something. This is about the highest we have seen it go, right? Which means that $1 against the naira over time has been rising, isn't it? So the value of the dollar to the naira is in an up. I don't know if you get my point. The prevailing currency is what forms the trend. So for the fact that the dollar is the prevailing currency and the dollar happens to be the base currency, you've heard of base currency? Don't base currency, right? Base currency and quote currency or counter currency. Now, just make it easy. The currency that comes first is like the base. It carries the value of the exchange rate. The one that comes second is the counter or the quote, right? So, the currency that comes first is usually the currency that determines the trend. The currency that comes what? Is the currency that does what? Determines the trend. What if I flip it the other way? I flip it now that it is NGN USD. NGN USD. Naira is coming first, then the dollar second, right? Good. That means it is no longer $1 is equal to something. It is now going to be what? 1 naira equals to how many dollars? Are we together? So the currency that comes first is one of these is equal to how many of these over time. So before, is it going to be rising like this now? Why are you laughing? God. I know what is in your mind. Most people cannot relate. 1 naira before was equal to how many dollars? Let's say like 20 years ago. Now, please get it to. You know, before we were doing $1 is equal to how many naira? So it was going from $1 is equal to 1 naira at some point. $1 became 2 naira. But this one is constant. The dollar is constant. It's not going anywhere. Now, before, the naira was even stronger. So before it was $1 to 1 naira. Let me put it this way. Then later, 1 naira to $1. Now, 1 naira is equal to $1 again. It's less, Abi? No, let's even say 1 naira was now equal to like 90 cents, which is $0.90, Abi? 1 naira now is equal to 0.80 cents. It was going down. I mean, that means 1 naira was losing power against the dollar. Right? So 1 naira now is equal to how many dollar? 0 point. How many cents? Sir? Is it rising or is it falling? It's falling. So is it going to be an uptrend or a downtrend? Are we getting the idea? So it's just telling you that the currency that comes first determines the trend of that particular chart. Let me give you an example again. Let's say EUR, Euro, JPY, Euro and Japanese yen. First of all, which currency do you think should be the stronger currency in that pair? Euro, right? You are right. Euro will be stronger than the Japanese yen most of the time. Are we together? Good. Now, because we have it as Euro and Japanese yen, which one comes first? Euro, right? So, given that Euro is the dominant currency there now, our trend should be what? Up or down? Uptrend. What if we now have something like AUD, USD, Australia dollar versus US dollar? What currency do you think should be the dominant currency there? US dollar. Good. Now, which one is the first currency there? Australia dollar. But Australia dollar is not the dominant currency. So now, should our trend be up or down? Our trend will obviously be what? So that's one thing you should have at the back of your mind when we are talking about trend. The prevailing thing that is happening. So when we are talking about currencies, trading currencies, you have to pair them to two. So in that pair, you must know the one that is prevailing, the one that is the most stronger currency in the pair most of the time. So that one forms the trend. But it does not necessarily mean the stronger currency have to be the one that comes first too. So your job is that one that comes first. Is it the prevailing currency, the stronger one? Yes, your trend will be up. The one that comes first, is it the prevailing currency, the stronger one? No, your trend will be down. Right? Please, are we getting this? Any question on this one? I'm sure most of you have done this one. All we are doing is still recap. I'm sure that there are other things we need to do for today. While you are here. So we're just trying to establish this one. Right? So your success in trading, most times, has to do with your ability to identify the trend. Are we together? Your ability to identify the trend. So, as a trader now, that you are used to trading USD JPY. From what we just did now, USD JPY, what direction do you think the trend should be going? Up or down? Are you sure? Now, including those online, I need you to let me know. What do you think? I'm sure there are persons online, right? Please drop it for me. What direction? Help me check. I want to know if they are following us, our spiritual audience. Let me ask the question again. From what we just did now about trend, we have USD JPY. What do you think should be the trend of USD JPY? That's the question. Should it be an uptrend or should it be a downtrend? Are there any responses? You see, when I tell you that, even when you're talking about trend, some people will still, if the trend is up, some people will still tell you it's down. And if the trend is down, some will still say it's up. That means not everybody will agree to the trend. But the fact is, majority will agree that this is the trend. Right? So, guys here, our physical audience, not spiritual now. What do you think should be the trend of USDJPY? Are you sure? Yes. Why? It can be up, it can be down, abi? You are right, it can be up, it can be down. Thank you. But in this case, the trend should be one direction, one. Why do you think? What do you think the trend should be? Yes. Why? There are more buyers in USD than JPY. Okay. You are still correct, but that should not necessarily be. Why are there more buyers for USD than JPY? You know, based on how I explained it to you, right? I said whenever two currencies appeared, both of them cannot have the same strength over time. One must be prevailing than the other, abi? Which I explained with the US dollar and the naira. Over time, we have found out that the US dollar is always dominating the naira. We explained with Euro JPY, right? That the euro is always mostly dominating the Japanese yen most of the time, right? Then I think we also did AUD USD, right? Now AUD is the currency that comes first, but AUD is not always dominating the dollar. So that trend will be down. Now, your job is to find out of these two currencies, which one is the first one. That is that base. Your reference will always be the base. Now, the base is what's the base here? The USD, right? So then you now come, which one should be the dominant currency? The USD. Good. Hence, obviously your trend will now be what? That is why it will be uptrend. So over time, over time you find out that the USD always dominates the Japanese. It's like a cheat code to understanding trend. So as a trader that I understand this one now, and I want to trade USD JPY, given that we are in an uptrend and the chart will mostly be going up, would I be more interested in doing buy or be more interested in doing sell? Buy, right? So it gives me an idea of what I should be doing most of the time. So if I am buying, and I can buy now and leave it for the next 1 month, 2 months, 3 months, obviously I will be profitable. There's a more than 70%, 80% chance that I'll be profitable. I don't know if you get my point. If I leave it to over, I might not be profitable right now because right now the Japanese yen might be slightly stronger than the US dollar. But the table will soon turn. After a period of time, the dollar will collect back that strength and dominate again. So even if I just do buy now, close my eye and buy USJPY and leave it for over a period of time, I'll be profitable. So traders that understand trend, they have even broken the work 50%. They have done the job 50%. What is left now is just to find that, you know what we call sniper entry. The people that have problem more in this market are day traders and scalpers. You know what I mean by day traders? Hey, day trader, intraday trader, or scalpers. You want to enter the market now, and you want the market, as you are entering like this, the thing should just be giving you profit. Which sometimes timing can be. For instance, yesterday I was buying USD JPY yesterday. I was buying USD JPY yesterday, and my buy was somewhere. Okay, I think I used a lower time frame, and my buy was somewhere. Was it around? Okay, I think my buy was somewhere around here. My buy was somewhere around here. I knew this guy was going to buy. But after buying, it bought a little. Then what happened? It started coming down, isn't it? Then later, before it started giving me profit. And although I've closed out that trade, if I remain on that trade, I know that the thing will continue giving what? Profits. Are we together now? So the problem is that if you want the profits right now, is a problem. It's a problem. But there's a way we can still do it, though. There's a way we can still do it. All right, so that is about trend. And let's shift to. Okay, so like I said, we have different types of trend. We have uptrend, then we have what? Downtrend. Let's keep all of that. Then obviously there are times where market will be going sideways in a range. When price is going in a range, it's one of the worst markets to trade. a sideways market. It's trapped in a range. It's one of the worst markets to trade. One of the worst markets to trade. The best market to trade is a trending market. Simple as that, right? Okay. All right. So we have retracement. After trend, we have retracement. Now, there are times where, just as I mentioned about yesterday, USD/JPY naturally is in an uptrend. Please, any question about trend? Any question about trend? So retracement is a temporary price movement against the established trend. So we have a trend that is to the upside, right? An uptrend. Then, what happens when price is not going up from here all the way to this point here? From here all the way to this point here. This is what we call the what? Retracement. Sometimes I can explain that as price pullback in the opposite direction of the trend. Is a temporary move. A temporary move. Temporarily. Price naturally should be going up, up, up. But there are a few times where price will stop going up and start going down. It can be for a few hours. It can be for a few days, right? Sometimes it can be as much as for a few weeks. It does not mean that we have changed trend. We are still in an uptrend, right? So this move will soon be over and price will continue in the direction of the trend. So that is simply retracement. Then continuation. After price finishes retracement, there will always be what? Continuation in the direction of the trend, right? Always continuation in the direction of the trend. So I think if we continue in this direction, we will not finish what we are doing. So let's quickly recap. You did support and resistance last time, right? Support and resistance. What is support? Yeah. Okay. Get the what? Trend, retracement, continuation. Okay, continuation. Continuation means when price resumes the direction of the trend. Price continues back in the direction of the trend. Yes. Gold and USD, that's XAUSD. Is an uptrend. Yes. How do you judge a trend? So how do you judge a trend? Where's my gold now? This is gold. This is gold. Let me put it on. This is gold on 1 hour time frame. This is gold on 1 hour. So you can see price moving like this. Now, on your lower time frames, price can be noisy, like very noisy. On lower time frames. I'm sure you understand that we have different time frames in the market. Now, what are time frames? Time frame is just a lens to which you are using to look at the price movement of the market. Your time frame. Time is infinite, it's parallel. Before you were born, time has been existing, right? When you were born, time continued to exist. You will die, time will continue to... I don't know if you get my point. Let's say you were born in 1990. Before 1990, time has existed. You were born 1990, time continued, and the person died 2020. Did time stop? So if we are judging that person, we'll say he lived from 1990 to 2020. Abi? So is a period of time that something happened. What happened? Somebody was born and he lived his life. Now, when it comes to the market, if you want to look at time frame, I have different time frames, but most of the popular time frame, especially if you are not using your trading view, if you are using your MT4 or MT5, this is MT4, we can as well use MT5. Most times, you will have some of the most popular time frames. You have your M1. What's M1? 1 minute, right? Then you have what again? On your MT4, MT5, you have M5, M15, M30. Is there another M again? What's M1? M5, M15, and M30. Good. So that's about the end. Then we now go to H1. H is hourly. So we have H1 and we have H4, right? Now, on your trading view or other platform, you can have H2, H3, right? Even H8, 8-hour time frame. But I'm just looking at the most popular, H1, H4. Then you can also have D1. D1 is what? Daily. You have W1 and you have MN, daily, weekly, and monthly. So if I'm using M1 time frame, it means that as price is moving, I am trying to judge time based on every 1 minute, every 1 minute, every 1 minute, every 1 minute. In this first 1 minute, the price go up, did it go down? Abi? That's what I'm interested. Are we together? In the next 1 minute, did it go up or did it go down? In the next 1 minute, did it go? If I'm using M5 now, I'm looking at price in this time frame of 5 minutes. Every 5 minutes, the last 5 minutes, the price go up or go down. The next 5 minutes, did it go up or go down? The next 5 minutes, right? So if I'm using 15 minutes, the same thing. H1, I'm looking at time based on every 1 hour. And it is significant in the market to do this. Very significant in the market to do that. Very significant in the market because price need, for you to be accurate, you need to attach time to price. Time to price. Time to price. Now, this is why you need it. Let me ask you this question. If January, hypothetically speaking now, by January, dollar to naira was, let's say, 1,200. Then by February, it rose to 1,700. And by March, it now became 1,600. 1,600. Now, if I want to sum it up now, say, oh, generally speaking now, the dollar to the naira, has the dollar been rising against the naira? If I ask generally speaking, your answer will be correct if I add time to it. This is why. From January to February, the dollar was gaining over naira because it was from 1.2, it went to 1.7. Abi? 500 naira difference between 1 month, isn't it? So it was rising. But between February and March, the thing dropped, isn't it? It dropped by what? 100 naira. So if I ask you, has it been rising or has it been falling? Overall, generally speaking, it has been rising. But if I ask you, between February and March, has the dollar been rising against naira or not? It went down, abi? So your answer will be accurate if I add time to it. So if we now say, in the last 1 hour, has price gone up or has it gone down? It makes us to be accurate in our analysis, right? Good. So this is where we need time frame, right? If not, we would have spent some time talking about it, but we really need to cover what we need to cover for today. And any question on this before we continue? So the last time you said you did support resistance, you did you did what? Inducement, liquidity, you did impulse correction, you did Fibonacci, Abi? You did Fibonacci, premium and discounts. Yeah? Okay. So where do we start from now, sir? I think the most important of all of those things that you are doing. Okay, internal and external structure, that's market structure. Good. So let's start from market structure. From market structure, we can now add all of these things, right? Now, you see, market structure is one of the most important analysis that every trader must know how to do. If you don't know how to do market structure, forget about it. You will most likely just be entering wrong trades. You'll be losing money anyhow. Market structure gives you a better perspective of what price is doing. And remember that technical analysis has to do with judging from what has happened in the past, using the past to predict the... So if you don't know what price is doing, how will you know what it will eventually do in future? So market structure gives you that perspective. For instance, using the word structure, let's say there are this building that we currently are in now, this building. You know, there's another building next to us. Abi? After that building, another building. They are all buildings, isn't it? Let's even say they are all having 10 floors each. But one thing is certain, the moment you enter from the entrance of the building at the ground floor, the structure of that building looks different from the previous structure. Abi? This building and the next building, they might both have 10 floors, but they are not the same. The way the staircase of this building is different from the way the staircase of that one will... I don't know if you get my point. The way the elevator of this building is will be different from that one. But one thing is certain. If you can understand the structure of this building, and somebody tells you, you go to this building with your friend, and you ask your friend to wait for you. You say, you want to have a meeting. You ask your friend to wait for you at the 5th floor. And you went all the way to the 8th floor to have your meeting. Then when you were done, you came back to the 5th floor and you didn't see your friend. And you called, where are you? Your friend tells you, oh, I'm currently at the 4th floor. I hope you will know your way to that point. I don't know if you get my point. Locating your friend will be easier at this point now. Because to an extent, you are in that building and you have understood the structure of that building. But if your friend tells you that I'm in the next building and I am in the 5th floor of the next building, I hope you know it will be slightly difficult for you to easily locate your friend because you don't know how that building looks like inside. You don't know where the staircase is. Most likely when you get to the building, you're asking somebody, where is the staircase? Where is the elevator? Abi? Even this building, some people, when you were coming in, you were asking, have you asked, where is the elevator? Yes. All right. Where's the elevator? And all. So for everything you are trading, it has a structure, both uptrend structure and downtrend structure. The market has a structure, and that structure gives it perspective, right? So when we are looking at market structure, I'm sure you have done this before, but let me just do a little bit of recap. Please, I might not be using the exact language that was used in the previous class, but I can assure you that it's the same thing that we are talking about. It's the same thing. So let me just give you a summary. Let's look at a bullish structure. We have 3 structures. We have bullish structure. That is for buy or uptrend structure. Then we have the bearish structure, which is for sell, which is a downtrend structure. In a bullish structure, price will always do what we call impulse retracement. I think maybe I should use this. Not too familiar with this, but let me try using this guy. No. I think let me just use my marker. Okay. Then the cleaning. To this. No. Let me take it out. All right. Thank you. So say I want to let me minimize this my screen. So for a bullish structure, we'll have the impulse, retracement, right? We'll have another impulse. It can be impulse correction, impulse correction, then impulse, another correction. So let's take why we need technical analysis. It helps us to know when to buy and when to sell. Abi, if I have a structure like this, after every impulse, there should be a correction. And after another impulse, there should be another correction. Another impulse, another correction. So they are in two different phases. Impulse phase correction, impulse correction, impulse correction. Abi? After the correction, what am I expecting next? Impulse, Abi? So I should be able to know that price, the next move should be an upward move. Abi? So this is what market structure helps you to know. Now, market structure, this is it, but trust me, it's usually more than this. I wish market structure is as easy as impulse correction, impulse correction. So let's do it again. Let me move this to the side. For every impulse that you have and the correction, another impulse, another correction, another impulse. You see this impulse in the real life scenario does not just go one straight line. It will do something like this on your lower time frames. Abi? It will be doing something like this. Then this correction will now start doing something like this too, right? It will look very, very choppy inside, very choppy outside, very choppy inside. So it's not, sometimes it can even drop like this, right? While moving. So it's not just a straight line. Are you getting the idea? Because the market, as much as possible, always want to bamboozle you, right? But if you understand that in doing market structure, there are two critical things that you must, 2 points that must be very critical to you. There are 2 points or 2 levels. The first is what we call your external swing points. Your external swing points. External swing. External. Impulse, retracement. Your external swings are your swing low and what? Your swing high. Here and here. These are the most important points to you. These are external. Everything, so you are trading in between this range now, in between this low and this high. So this is your trading range. Whatever happens inside of this range, they are called internal. Are we together? Internal. Now, the internal does not have any specific rule. The internal can move as it likes. But one thing is sure, that if I am in a bullish trend, this internal like this, no matter how much it likes, let it come. It shouldn't go below this level. The worst it should go is here. It shouldn't go below this point. Are we together now? If it goes below this point, it has invalidated our bullish structure. Are we together? We are no longer in a bullish structure. That's like a change of character. I'm sure you've done change of character, right? You don't break of structure, then change of character. If it goes below this point, it has invalidated our structure, right? So, but mostly, price should come back up and give us another impulse, then another retracement. So let's do this again. I'll always be counseling this thing. Please bear with me. Impulse, retracement starts. Where are my two most important points? My swing low and my Abi? These are external, isn't it? Everything that is happening inside becomes internal. We'll do this thing 3 times, and the 3 times I'll show you in 3 ways. So this is the first way. Now, price can do that impulse to this point, then finish the impulse and resume back in the direction of the trend, giving us another impulse. Then at some point, this impulse will end and it will start to do what? To retrace, Abi? Now, the moment price broke out of the first range, this range that we had, to go and give us another high and start doing retracement, we are no longer trading between this range and this range. We now have a new range. We have a new low and a new high. Where's our new low? Here? 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 Yes, this is our new low. This is our new low, and this becomes our new high. So we are no longer trading between this range now. We are now trading between this range. Are we together? What forms your new low? Your low is the lowest point of this, your retracement. The lowest point. That's your low. The lowest point of your retracement before price formed a new high is your low, right? Let's do it this way. Maybe this one is slow. Let's do it here. Impulse, retracement, swing low, and swing high. Then price finish retracing, resumes another impulse now. You will get a swing low, which means that the lowest point of this your retracement or the correctional move will now become your new low, isn't it? So this is no longer your low. It's no longer your low. It's no longer your low. And since price has gone up, sometimes it can go as high as this place retrace. Price goes, then all of a sudden it starts to retrace, right? So this will now become your new high. This is no longer your high. You now have a new dealing range, which is from this low to this high. Now, technically, in a bullish structure, price can come down as it likes. It can even come down as much as your low, right? But what it shouldn't do is to go below your... Are we getting the idea now? But most times, it shouldn't even get to your low, most times. It shouldn't get there, right? It shouldn't get to your low. That's why we have... This is a high. This is a... Sorry, this is a low. Or we call it a higher low. Please, let's have our phones on silent. We have a higher low, then we have a higher high. Then we have another higher low and another higher high. In a bullish structure, everything starts from high. Your lows are first of all high. So you have a higher low, then a higher high. In a bullish structure, everything starts from what? High. Everything is high. So before you say low or before you say high, you must first say one high first. So we have a higher low and a what? Higher high. Now, let's assume price now does this. Then all of a sudden, you now notice that price stops going down and price starts going up again. We assume the retracement is over, Abi? Then what are we assuming should happen? Should it stop here? Should it just stop here? Should it just stop here? What are you expecting should happen? Should it get here and stop? Although sometimes it can, but at some point, it should even go higher than this to give you a... start buying from here if your timing is perfect. Which is, it does not always happen like that. Hello? I'm sure some of you trade here, right? You trade live account. Like I told you yesterday, my USJPY trade. I entered, it went up a bit, some profits. All of a sudden, it started to dip, and I was buying. In fact, I was in drawdown for close to like 4-5 hours before price eventually, like from the drawdown to when price recovered and started giving me profit again, right? And I was hoping to close my trade before FOMC of last night. And I entered around past 11 yesterday morning. So I was becoming worried. Let FOMC, when fundamentals come out like that, the thing will just move price anyhow. Have you traded fundamental before? So have you traded fundamental before? You've traded it. Times where fundamental did not go in your direction, how does it feel? It will look like the whole world is against you. Like the whole world is against you very fast. But whenever you trade fundamental, let's say you trade NFP, FOMC, CPI, and the thing goes your direction, you feel like you are the owner of the market. you own this market, all right? So market structure gives us idea of. So when we say we study the past to predict the future, the past will help us to understand the current structure that we have. Are we together now? You will now use the knowledge of that structure to know what should happen next. And when you know what should happen next, that is where you now find your entry point. Are we together now? Good. So I know that usually price should do impulse retracement, impulse retracement, impulse. Now, price has gone very, very high. Some persons will buy from here. Some can buy from here, Abi. Some can even join the buy from here. And some can join the buy. Immediately price breaks out from the previous high, isn't it? Some buy breakout traders, right? Now, after price breaks out, if you don't buy from here, okay, it is very dangerous to start buying around this point too. You know why? At any point, retracement can start again. So the problem with this one is that imagine somebody buying from this point now. Your entry is here, and price now start doing some retracement. You can see it's massive. And it does it up to this point. It's massive. So your drawdown will be much. That's if you don't have a stop loss, which I don't recommend. Always have a stop loss is your fail safe. Me, I call it we live to fight another day. That you lose a trade is not the end of the world. It does not mean you're a bad trader. I mean, your timing might not be right. Or the market is full of different players. The market is full of, apart from fundamentals, there are certain things that will just happen in the market that even your forest factory did not capture. Investing.com did not capture. I mean, there's something that happened in the market that you'll be wondering, why is this thing happening? It's not in the news. So it can happen like that. It can hit your stop loss, and eventually, this thing got very, very close to my stop loss for USJPY. And at the same time, I was trading Euro AUD also buy at the same time too. I think I found entry for that one. That one is still going well. I'm still on that trade currently. I'm not even close because I know the thing should keep going. Are we together? So now I'm trying to balance this thing so that we can continue. So after price does something like this, then all of a sudden you see price start doing like this. What should you start doing? You should start buying, Abi. What if we have a scenario like this? After price has done this impulse, then it starts retracing, then it turns and starts going to the upside. Will you buy? Will you buy? What will you do? Huh? What are you waiting for? Guys online, please tell me, will you buy? at this point? Or will you be waiting like Odogu here? Our Odogu. Price. See, this market, let's go deeper. Let's go deeper. This market is spiritual. It's a spiritual market. How do I know it's spiritual? Have you not dreamt about this market before? You will be in your dream and you are trading. It's not normal. I will wake up sometimes in the middle of the night and I'll find it hard to go back to sleep until I open MT4, MT5. The moment I open MT4 and I see that the market is still alive, it's still moving, sleep will come. Sleep will come. It's a spiritual thing. Very spiritual. So you need to be spiritual. You cannot be carnally minded and be trading this market. You cannot. There are times where clear eye will not solve it. You know all these people that commit atrocity, criminals that rob, those hired assassins that kill people. It's not normal thing. So you cannot be normal to do it. You cannot be normal in a spiritual market like this. Now, that is just aside. It's just on the side. But this is what I'm talking about. There are some techniques to this thing. A good retracement, there's something we call, I have a principle, and that principle is not how far, but the principle is how well. It's not how far, but how what? It depends on how well you can understand this thing. Market structure is very important. Very, very important. And you should understand the market structure inside and outside. If you can understand it, you have solved more than 70% of your trading problems. You have solved it. I wish I can just carry my head and put it like this. Now, this is what I mean. Imagine that we are moving this way. Then, a good retracement, what qualifies as a retracement? You should know. There are differences between retracement, or there are different kinds of moves in the market that should not be qualified as retracement. So imagine that after price does this, it gives us retracement normally, then it goes up again. Then all of a sudden, it starts doing something like this. And it continues. Is this a retracement? This is not a retracement though. What is price doing? Price is just consolidating at this point. It's ranging. It means that price has not completed that move that is making. So the whole of this move from here to this point is the same move. Oh. Are you getting the idea now? Price has not yet done retracement. We are still expecting that retracement. But if you mark this point as, price has done retracement, it has gone up. In future, when price starts to retrace and you are looking for entry point, there will be problem. You will most likely miss your entry point. You most likely. This is scenario 1. Please, are you guys understand? If you don't understand, just call my attention back to it, all right? Now, scenario 2 is this. Price has gone up. I think price has gone up. And it does something like this. And it continues to the upside. Yes, this is a retracement though, but it's not a good enough retracement. I don't know if you get my point. You know what your retracement does for you? Think about it this way. Think of it this way. Think of it this way. Think of it like you are constructing a building. Let's use building because it's market structure so that you understand structure. Now, and this structure is bullish, which means that we are going higher and higher. Abi? Consider it like your staircase, isn't it? Your staircase, you are climbing, or price is going higher and higher. Imagine that after you go from ground floor to first floor, and you need to cement that floor, like you need to hold it very well, Abi, before you can go to the next floor. Now imagine that this is a weak floor now, a weak one, which means that what your market structure is to do for you is that your retracement, like this retracement now, which is good enough, for instance, should give you your low, Abi? So much so that when price comes, this your solid retracement will defend this level enough that price cannot break below, Abi, because it's already strong enough to hold price and to send it back to the upside. But this one like this is not strong enough to hold price when price is doing retracement, Abi. It's not strong enough. So there is most likely going to be a break below it. Are we together now? So just like the first one that was just ranging, is not strong enough. There is most likely going to be a break. So if you are considering this place as your new low now, hoping that when price gets here, it shouldn't go below your low, you'll be shocked that price will go below. Are you getting the scenario? Because there are somebody said, if you don't know where you're going to, everywhere you get to will look like where you're going to. So you must understand what your impulse and your retracement should look like. So when the market is not giving you that, you know that this is not good enough. Are we together now? It's not good enough. Then scenario 3. You remember the first scenario? Let me break it down. Is there any question online? Any question? The first scenario, right? This is why, if you think you understand market structure, you have basic knowledge of market structure. The problem is, when you come to the real market now, the market will punish you for your shallow knowledge of market structure. Are we getting it? It will punish you. That's why somebody will say, oh, Sebi, you thought like this, and I bought like this, but you don't understand that not all retracements are actually retracements. You need to know the ones that qualify to be retracement. It's mechanical, right? They are rule-based. So let's go back to scenario 1. Scenario 1 is like this. Price does an impulse, then it retraces. Okay, let me skip the first one. It starts retracing, and instead, the retracement starts looking like this. And after a while, breaks out and continues that particular move. So what we are saying is, the whole of this move like this one, is not good enough to qualify as retracement. Hence, when price is coming down, there is a very high tendency that price will go below this level. Are we together? So if you have marked this place as a low, hoping that based on the rule of market structure, that when you are bullish and price has created a high and is retracing, it cannot go below the low, or it should not. Not that it cannot, but it should not. If it does, it invalidates our structure, right? So if you consider this as a low and price goes below it, it has not invalidated our bullish structure. It has only invalidated what you think is your low, which does not qualify as low. Why? Yes, when we get to liquidity, we'll talk about this, right? We'll talk about this when we get to liquidity, because this is very good. In some scenarios, it's a very good. For those who understand liquidity, you will know how to use these points to also add to your confluence to trade. But if you are doing only market structure, okay, you cannot use this place as an inference to trade, because price will most likely go below it. And if you have taken a position at this point, you most likely lose that trade, right? Or if you don't close it, you have huge drawdown, right? That will scare you out of the market. So price does this, then price continues back to the upside. This is scenario 1. I hope you understand scenario 1 now again. This is scenario 1. That means we'll recap scenario 2. This kind of price movement is very good for supply and demand traders. Essentially, supply and demand traders, right? We use those levels very well as liquidity levels. We call it so there's drop-based drop. Let's leave all of that for now, so that I will not. Now, scenario 2 is price pushes to the upside, but does a little bit of retracement And all of a sudden, price then continues to the upside again. The impulsive move. This little retracement, yes, it's a retracement, but is it strong enough to hold price when price is coming back to the low? No. So it cannot be considered. Instead, you will still take this as your low. This is still your low. The whole of this move is one massive move to the upside. Price just have a little bit of interference. While moving, then it continued his journey, right? So if you don't understand that this is not good enough and you take this as your low, you possibly find yourself in a bad situation when you take trade around that level, right? Then scenario 3. Although scenario 3 happens on rare occasions. Fundamentals can cause scenario 3. It can last for a while. Scenario 3 is like this. You have the impulse. Then you have either a combination of 1 and 2, which is it can either just be a small range, then continue, and yet another small retracement and continues. This is scenario 3. Does this qualify as retracement? Does this also qualify as retracement? Which means we still don't have a low yet. We still don't have a new low. This is still our low. Which means that at some point we will experience massive downward movements because the distance between our low and our high is very, very far now. So you will now see a scenario where price will now start coming lower. All of a sudden, push massively to. So this is scenario 3. So I'm just pointing out the different scenarios where retracement has not happened in your market structure yet. All you are still experiencing is the impulsive move. And fundamentals can cause it. Fundamentals that shift price in one direction and make, for instance, things like CPI. CPI is consumer price index. It checks inflation rate, abi? Now, when CPI comes out, at the same time, is either they are increasing interest rate. Reduced interest rate is bad for currency. Now, why is an increased interest rate good? When you increase interest rates, it means you are trying to control inflation, abi? Hello? Meanwhile, they don't increase interest rates when things are good, though. They only increase interest rates when things are bad, when there is already some level of inflation and things are bad. So the increase in interest rate is to correct that bad to become good. Abi? So when your currency is down, the best, so I don't want to give you this cheat code, but if before CPI, how many of you know CPI, right? For those that are trade, CPI, Consumer Price Index, fundamental. You've never traded before? Sir? For now, but don't worry. You will trade. Now, for those who are trading already, even physically or spiritually, sorry, online. Please, if you hear me say spiritual, I'm talking to the online audience. Now, if you notice that dollar has been down prior to CPI, especially it has been down for, this CPI is a monthly news, abi? It has been down for at least 2 weeks. At least half of the month, 2 weeks, dollar has been down. And that 2 weeks is possibly even leading to the next CPI, right? The most likely scenario is that Jerome Powell and the Fed, Fed team, they will most likely introduce the fiscal policy of increasing interest rates, right? So that they will discourage people. Why is there inflation in the first place? It's because there's a lot of money in circulation, abi? People have a lot of money is out there pursuing fewer goods, right? So it becomes the choice of I have money, you have money. We want to buy the same thing. The seller will only sell to the highest bidder, isn't it? So it makes price possibly start to rise. So what to do is to mop out that money. Find a way to take money out of people's hand, right? So first of all, let us not add money to the economy. So we will increase interest rate from borrowing. So it will discourage people from borrowing more money and adding to the economy. So the few money in circulation will now increase in value. Are we getting the idea now? So it's just it has multiplier effect. One thing leads to another, right? So increased interest rates leads to higher currency value. All of a sudden, dollar will just rise again. It will peak, right? It will peak, and before you know, for the following week, next week, it will just keep getting stronger and stronger. And reverse is the case. Although when dollar is high, okay. Thank. Reverse is the case. Sometimes when the dollar is high, they might still leave interest rates the same. I know sometimes it can be the same. They'll not tamper it, right? Then, but when the dollar is high and it has been high over time, right? So there's a very high tendency that CPI will come out. They want to reduce, right? So these are just some of the tips and tricks to trading fundamentals. But on the chart also, these are some of the market structures that we have. Any other question about market structure? Let's do the bearish structure. We just did bullish structure. Let's do bearish structure now. Oh, thank you. I told you what is not a retracement. So we ought to do what is a retracement. Yeah. So a good retracement is such that should cover at least 50% of that impulsive move. A good retracement is such that should cover at least 50% of that impulsive move, which means that the retracement should cover at least 50% of the previous move, which is if price goes from here all the way here, a good retracement should be from here to here, 50% of this move down. Are we together? It should cover at least. It can cover more. If it covers more, excellent. But at least it should cover 50% for it to be referred to as a good retracement. It makes this level much more solid. It brings about much more liquidity because as it's coming down, it's creating liquidity. So much so that that liquidity is what it will gather to. It's just like somebody that has a boxing match, and that person took a lot of time to prepare for the match. Abi, there's a very high tendency that the person will perform well. But if you have just a short time to prepare for the match, there's a possibility of a poor result. Are you getting the idea now? Retracement. Huh? This next move here will be much more solid because this place, there's a lot of especially after 6 months to 1 year of that strategy. The market always adapts, always adjusts. The market will just adapt itself. So that your strategy that is working for you, after a couple of months, you notice that that strategy, sometimes it works, sometimes it doesn't work, sometimes it works, then later, it feels like it doesn't really work. The market has adapted. You have not adapted. Are you getting the point? So you need to also adapt with the market. If all you understand is impulse retracement, if the market is doing impulse retracement, you'll be making profit. But when the market starts doing some complicated level of impulse retracement now, like the ones that I said are not retracement, Abi, if you are considering them to be retracement, the market will wipe you at that point. So you will need to now adjust that, okay, it's not about impulse retracement. What qualifies as a retracement and what does not qualify? So at least 50% of this impulsive move, right? Which means that your retracement is as good as your impulse. What do I mean? Your retracement is as good as your impulse. You have to read what the market is doing. Don't try to guess. Just look at the market and how the market moved. If price does something like this, just a little impulse, which means that your retracement or correction too will be little, isn't it? Hello, Abi? What if price now does something like this, massive one? Do you expect your retracement to be short? Are we together? You expect at least what? 50% of this move all the way to the downside. That is where we introduce Fibonacci now. For those who trade Fibonacci. And you know, I don't know, I'm sure you were told the last time that you don't use your Fibonacci to buy until from swing low to swing high, price retraces back to at least 50%. Abi? You remember? Those who were here. Until price retraces how many percent? 50. There's 26.6, 38.2, there's 50, there's 61.8, there's 70 point something, then there's 100%. 100% is back to your swing low, right? So you start counting the level, 21.8. Let me see, let me apply my Fibonacci. Okay, let me draw something like this. So from the impulse, which means our retracement is going to be small. Then another impulse, massive one like this. So it means that this is my low. Are we seeing this, guys? This is my low right here. Now, my retracement cannot be less than 50%. So I can apply my Fibonacci from swing low all the way to swing high. And all I am waiting for, oh, I have this. All I am waiting for is, you can see my level 0. You can see my level 23.6, Abi. You can see the next level what? 38.2. Then you can see the next level 50. Then you can see the next level 61.8. I've removed this one. Then 100%. 100 means that price came back all the way to your low. Full retracement. So I will be waiting for price around this level. I'll be waiting for price anywhere from this 50% level. Anywhere around this point. So I said at least 50%, which means that it can go lower than 50, but it should be at least 50. So what I will then be doing is, from this 50% level, my retracement must come into this range or possibly below for me to then have a trade. If it doesn't come to this level, I don't have a trade. It can even fake you out and stop at 38.2. So from our previous instruction now, I hope you now realize that your 23.6% level, that if it comes here and it goes up, it's not retracement. I mean, it's retracement, but it's not a good enough retracement. If it comes to your 38.2 level, it's retracement, but it's not a good enough retracement until it enters your 50. It enters your 50. Now, one of the things it will do for you is that if at all, because price can be funny, price can then do like it wants to go, start going to the upside. At this time now, a lot of persons will be jumping in for buy, Abi? Buy. Then sometimes price can come down. It can come down a bit like that, or do a little bit of downward movement before finally pushing out. Before finally pushing to the upside. So irrespective, if you have entered your buy from here or even from up here, and maybe you were in small profit and it goes against you, hope you know that it didn't go too far. Abi? It didn't go too far, which means you will just have a little bit of drawdown, right? Before price will. But if you have entered from this 23.6 and price look like it wants to go and continues down, your drawdown will be more. If you enter from 38.2 and it looks like you want to go and you enter, but if it enters from 50 and it's going, even if you enter and price goes to the downside again, the distance will most likely not be much before it will. So it will save you from huge drawdown. And also, you have the potential of a higher profit. Because if you are taking your trade from here, usually you target the previous high, Abi, to take your profit. So the distance between you and your profit will be more. All right, you gain more pips in profitability. So let's say you entered from even around this level, it came against you and it went. At least you still make some decent profit compared to if I enter from here and price eventually even goes to the upside. Hope you know my take profit is not much. I won't make much money. If I enter from here, I won't really make as much though. But if I enter from here or even possibly lower, I will make more profit, right? So this is why we use Fibonacci. Is there anybody here who has never heard of Fibonacci before? Especially those online now. You've never heard of Fibonacci? Never ever. Ever. It's your first time? Okay, Fibonacci is actually a retracement tool. Excuse me. So having understood having understood a bit of market structure, remember I told you that at least 70% of your problem in the market will be solved, Abi? You understand direction. The only problem now is timing, isn't it? Timing to enter your trade. Where should I enter? Should I enter from here? Should I enter from here? Now, you now need, this is where your strategy now comes in. So Fibonacci is a tool that people use to know exactly when to enter the market. Now, what is Fibonacci? Like I said, it's a retracement tool. It's a retracement tool. I'm not going into history, how they came about Fibonacci. This one mathematician, an Italian, a French mathematician, all of that. You can go and research that one. For our next class, you will assignment. Let me do like my lesson teacher. I remember in primary school, hey, I was very dull. My God. I was so dull that as at primary 6, so I don't like to read. Reading is very stressful. But give me football. We can be there all day. You know when we are on holiday? 8 a.m., 9 a.m., we are already out of the house. We'll be coming back around 6:37. Like, everywhere will be dark. Like, you cannot see again. If everywhere is bright around 9 p.m., we'll still be playing ball. We don't bother about food. Don't give us food. Don't worry. We'll be drinking water. We will play for like 3 hours, 4 hours. We'll rest. We can rest for 30 minutes, just for 1 hour. We'll start playing again. And we're not asking for food, though. Just give us football. So in class, I was not performing. I was not reading, nothing. Out of 52 in primary 6, I came, what position? 50. Only 2 people that I passed. Samson and Edward. I cannot forget their name. Samson and Edward. Those 2 guys, the 3 of us used to sit down at the back of the class. You know, primary 6 is the most senior class in primary. So we are the ones that have prefects and all the, you know, those days, it's not school now that, those days, if you come late, you will cut grass. They will give you broom to sweep. So all the cutlasses, all the brooms that we used to give junior students to do all those things, they used to be inside our class. And we used to keep them at the back. So we used to sit down where those tools are. And there's a small store. So what we'll do is, when Mrs. Magaji, our mathematics teacher, is teaching us mathematics, me, Edward, Samson, and there's one guy that has half of his teeth. You know when someone has teeth cut? One Yoruba guy, I can't remember his name very well, maybe Kunle or something. The four of us used to, but that boy, thank God, his parents got him lesson teacher. So he could, leave us out of that trench. I came 50 out of 52. Very bad. When I got a lesson teacher, Mr. Kelvin, he's now a lecturer at University of Abuja, Mr. Kelvin. This man, he will give us assignments that you know that you can never finish. He understood that my problem was that I don't like to read, Abi. So he substituted play for book for me. And how? He will give me an assignment that I cannot finish. You see all these primary school Macmillan then, Ugo, all those textbooks. On mathematics, you will buy every textbook on mathematics. Every single text. So if he's teaching fraction, you will do all the exercise in Macmillan, all the exercise in Ugo, all the exercise in every single textbook. And you have 24 hours to do it. So for everyone that you did not do, 2 strokes of the cane. For everyone you failed, 4 strokes of the cane. So I will do rubbish. It's better for me to do rubbish and fail. We almost are. So let me be like my lesson teacher now. I want to give you assignments. And what's that assignment? Go and find out who invented Fibonacci. Do you get that? Find out who invented what? Fibonacci. So I will just tell you simply how we use Fibonacci alongside our market structure to understand when to take our trade. Fibonacci. If you want to pronounce it, it can be Fibonacci. Fibo. Double C-I. F-I-B-O, N-A-C-C-I.
Someone in the chat said
Can they say what?
Can they say it?
Say it now. Say it where you are. Don't worry, I'll hear. Ask spiritual yes. Mm-hmm. You want to pronounce Fibonacci, you bite your tongue. Mm-hmm. There are others, most of the strategies that we use, they're either French or Italian that came up with them. Right? Now, Fibonacci, like I said, is a retracement tool. Retracement tool. We use it to measure retracement. Retracement tool. To measure the extent of retracement after an impulse. So we are going to be measuring it from 0 to 23.6 to 38.2 to 50 to 61.8 to 100. In fact, if you go in details of the origin of Fibonacci, Fibonacci applies to a lot of things in our life. Now, even your ear has to do with Fibonacci. The music score sheet that we use, everything has to do with Fibonacci. Everything is revolving. But let me give you my own principle of Fibonacci, because Fibonacci gives us an idea of what we call premium and discount. If you remember from the last class, right? Gives us an idea of premium and discount. Now, why is it that 50% is our point of interest, or 50% and below is our point of interest, POI, point of interest? It's because there is a principle called premium and discount, which is anything above 50%, it is not yet cheap enough, it's still high. But anything below 50%, price is now cheap. I think I was doing something before we started, where I was trying to bring our attention back to that thing that they used to teach us in high school then, secondary school. How many of you drew demand and supply curve while you were in school? Demand and supply. Everything we are doing is buying and selling here, demand and supply. Did you draw demand and supply curve that year? If you did not draw it, you will draw it by force today. Everybody, you must have your book, or if you don't have your book, whatever to draw it. Those of you online, draw demand and supply curve. You must draw it. You will show me, I will mark it. I want to mark your supply and demand curve. This is it. Now, You remember what we used to do then? I think I need to use black first so that I have multicolors. Pardon my line. Now, this kind of curve, remember. And remember that our teachers there, if you draw curve and you don't put this point as 0, they will fail you. Then this one slanting from up to down is usually Y. And the Y represents price. You remember? Price. This place is where you put price. Then this place usually represents mostly Q. And Q is for what? Quantity. Remember? Then anything above 0 is positive. Anything below 0 is what? Negative, right? So Y here represents price. Now let's put more context to it. So let's assume that we are dealing with a bag of rice. Bag of rice. If a bag of rice is 10,000, 10K, and a bag of rice is 20K, a bag of rice is 30K, 40K, and let's stop at 50K. Then, when bag of rice is at 10K, let's assume that you can buy 1, 2, 3 bags, 4 bags, and 5. This is quantity, Abi? So 1 bag, 2 bags, 3 bags, 4 bags, and 5 bags. Now, if a bag of rice, the principle of demand says that the lower the price, the higher the quantity demanded, Abi? And the higher the price, the lower the quantity demand. So when price is low, the lower the price, the higher the quantity demanded. When price is at 10K, 10,000 per bag, you will not buy 1. You will not buy 2. You will not buy 3. You will not buy 4. How many will you buy? As much as you can buy. So the lower the price, the higher the quantity demanded. So you buy more. When price increase to 20K now, as price is increasing, your demand will be reducing. So at 20K, let's say you can buy only, this is my curve that is not curving. You can buy only 4. At 30K, your demand is reducing. You can see the bag of rice you can buy is reducing, right? At 40K, it reduces to 2. And at 50K, the highest price, you can only buy the barest minimum. Are we getting the idea? So your demand curve will always slope from left to right. That's the idea we used to use then. How many of you got this thing in school? Don't lie. Don't lie. Now, for supply is the opposite of demand now, but with a twist, which is somebody will only want to sell something to you at the highest price, Abi? So if supplier says that the higher the price, the higher the quantity supplied, Ibi, at the highest price, a seller will want to sell more. But when price drops, sellers will sell less. So the higher the price, the lower the quantity supplied. And the lower the price, the lower the quantity supplied. So at 10,000, a seller will only supply 2. He doesn't want to sell much. Are you getting it? Or at 50,000, if you are selling something at 50,000, a seller wants to sell more at a high price. True or false? So the seller will come and want to sell as much as he can. If you reduce price, sellers will reduce the quantity they sell to 40. If you reduce to 30, sellers will reduce to 3. Abi? If you reduce price to 20, sellers will reduce it to 2. And if you reduce price to 10, they will only sell 1 bag. Are you getting the idea? Now, the middle, so this one is sloping this way from left, up, down, and this one is sloping down, up. That's connecting all the dots, right? The point of intersection, who remembers the name? Not you, sir. The point of intersection, who remembers the name they call it? I want those people that to say it. If you're in class here, somebody whisper it in your ear. Then we know what the teacher will do. Samson. You remember Samson and Edward? You have forgotten them. The two people that I passed. Samson and Edward. Very. Samson, what is the middle of this line called? Samson will say, you'll be looking at Edward. Edward will be looking at Samson. You'll be looking at me. All right, so it's called equilibrium. So the midpoint of both suppliers and of buyers and sellers is equilibrium. You get it, Abi? Now, anything or anywhere above equilibrium is referred to as premium, which is price is high. And anywhere below equilibrium is referred to as what? Discounts. Which means price is high or low? Low. So as buyers, this is our dealing range as buyers, below equilibrium. I want to see this in your note. You must draw. You must draw. Maybe if I give a price to it, how much should I give for the best drawer? How much do you want? $100. Okay, let's do it in 900K. The best drawer, online and offline, so that I can give two people do $50. Two people. You will submit it today now. Yes, now. If I clean this thing now, how many of you can draw it again? Oh, let me clean it. Because some of you weren't following me, actually. I know. Draw it and see if I will not give you your $50. You want to know if I'm serious? Draw it first. Draw it first. Who wouldn't draw? Even, guess what? Me too, I will draw. I withdraw. So if your own beats my own. So if I don't come first, I should come second. So I'll get $50. Because I'm not the one giving the money. There's a provision for it, don't worry. Don't worry, you get the money. Is there anybody that has drawn their own there? Can they show us? Can they show me? Mark. They cannot. But if you are sure you can draw this thing, let me know so that we'll know how we arrange your money. If you are sure, let me know. Supply and demand. See, the truth is that trading is about buying and what? Selling, isn't it? Now, if you can wrap this idea in your head, it helps you. All of these simple things that we are doing, they are what cumulates to what we are doing in the market trade. But you look at it as abstract. I'm trying to put context into it now. I recently met my lecturer in, I think he did 100 level and 200 level, Dr. Mohammed. I recently met him in my estate. I was, that should be on, was it Friday? Public holiday. Yeah, we had public holiday Friday, right? On Friday. So I had my headphone on. I put it and I was doing one spiritual activity that I like to do, prayer walk. I'll just put my headphone, be playing music to shut myself out. And as I'm walking, I'll just be, you understand that communicating with my heavenly, so I do it a lot. So from the gate of my estate to my house is quite a distance. So it will take me about 28 to 30 minutes thereabout, depending on how fast I walk. So I will use that distance to just do it. So I was doing it. All of a sudden, I met him. I just saw somewhere that looked like him, and I stopped and I called him. And some of the things this man taught me, There are some of the things I'm still using till today. Structure of Nigeria economy. You know, we are talking about structure. Structure of Nigeria economy. We talk about the downstream, petroleum economics. We even talk about all of these supply demand, put context to it. Then we did, there is this combination, econometrics, combination of mathematics, statistics, and economics, right? Where we'll do all this national income and the likes. Now, some of these things are things that we use in context. So what am I saying is, you would think this one does not have any value until I remove some of these things now. Where is the marker? The cleaner. If I remove all of this curve and I leave equilibrium, premium, and discount, right? Let me remove the rest. I leave equilibrium, premium, and discount. This is equilibrium point. So below equilibrium, okay. So what are we talking about? If I will add some context into this one, this is simply saying that price has done a high, like an impulse. Price has done an impulse, and after the impulse, price is trying to do retracement. Are we together now? Let me not make the impulse this high so that it will capture. Price has done an impulse. Price started from origin 0. Remember your origin. Hello? Your origin 0, Abby. So price started from here, and price has done impulse. Then after the impulse, price is now doing something called what? Retracement, Abby? And a good retracement should be how many percent? 50%, which means that from this your origin 0, price has gone up previously. So you are waiting for price to retrace 50% and below for you to now take your trade. So one of the tools that we use to help us to capture, measure that retracement of that 50% is what? Fibonacci retracement tool. And how do you use Fibonacci? On your chart, on your MT4, on your MT5, Fibonacci is, if you just apply this one, Fibonacci is here. You see these lines, 4 lines with an F below. Or another way to do it is to go to insert. You see insert here. You can come to insert. Then you can see Fibonacci here, right? Then you see retracement. It's a retracement tool. Insert, Fibonacci, retracement. There is Fibonacci retracement and there's Fibonacci expansion. That is like mathematics and advanced math, further math, right? But let us do mathematics first. So we will now come to pick our, once you click it, it brings the, oh, we might not have this one again. All right. Once you click on Fibonacci, so because if you want to be using Fibonacci more often, once you use, normally it appears down here already, right? So this is just easy pick. Click here and you pick it. So let me go to a real scenario on the chart now. Real scenario on the chart. Let me pick an instrument. Any instrument to analyze. Or let's say Euro CHF, for instance. All right, let me capture this. Now, if I'm to use my Fibonacci retracement tool, my current directional bias, which direction is price moving? Sorry. What direction is price moving more? Let me start from here. Let me start from here, for instance. So I have a swing high. I have a low, and I have a what? A high, right? So if I'm to use Fibonacci, if you are in an uptrend, you place your Fibonacci from the low to the high. You will now start measuring that retracement all the way down. And if price does not come to 50% and below, we are not yet buying. So if I apply my Fib, I put it from low. Now, all the way to the wick of the candle. Put it from low all the way to my high, to the highest point of the candle. Good. So I'm interested more in from my 50%, which is, here is my 50%. Let me take this one out first. Here's my 50%. Aha, this point here. So anywhere from up here all the way, anywhere from my 50%, I am interested in, this is from the point now, anywhere from 50% and below. So that's why I capture from 50% below, right? Now, you notice that the first time when price started retracement, it got to this point. What point was this? 38.2. It got to 38.2. It looked like it was about going, Abi. Most times it can be fake out, like I explained before. So once you enter, the problem now is once it continues down again, there can be problem. So fake out, it continues down straight. It gets to 50%. Now, it didn't stop. Even if you take your buy from here, inside of this point of interest, I hope you know that you will not stay too long in the drawdown before you be out of drawdown, Abi. So one of the advantages is that you won't stay too long in the drawdown. Then, one of principle also that you need to apply is that you should always wait for a bullish move to the upside. Are we together? Because sometimes you never can tell exactly where price will stop. So I need to see price stop first, and I need to see price go. There's something you usually say. Trying to buy when price is falling massively like this is like trying to catch a falling knife. Somebody stands from 2 or 3 story building and he throws a knife to you from up, and you want to catch it with your bare hands. How do you think it will happen? Very dangerous, right? Allow the knife to fall first. When the knife stops falling, it has hit the ground. Then you do what? To avoid stories that touch. So when price comes into my point of interest, one of the things you do is you don't just buy. Mostly you should look for a bullish reversal, either a bullish engulfing candle or even a hammer. How many of you know bullish engulfing? Bullish engulfing? Nobody? Okay. Okay. You've never attended the basic class. Unfortunately, where we need to talk about all of those stuffs are from the beginning class. But let me just can I take like 3 to 5 minutes to educate you on that? Can we do that? Yes. Guys online, can we do that? 3 to 5 minutes, educate you on candlesticks. Yes. Because it's very important, though, to save you a lot. To save you a lot. So nobody wants to win the $50, right? You are done. Who will mark it for us now? There's a marking technique we used to do that time. You know, when we are plenty and we do work, and your teacher wants to be lazy about marking, your teacher will say, give exchange. If you notice that your neighbor's own is finer than your own, cancel your own. Just know that you have lost. Mm-hmm. If your neighbor's own is finer than your own, know that you have lost too.
This thing is a bit, it goes up there, then it goes down again.
Where? Okay,
Yeah,
here, right?
And then it still went up.
Ah, there was one example I showed you now. Price can dribble you.
So that means if you are taking it at that point.
Okay, let's say if you have taken it after this bullish candle, right? You took it at this point, which means you are doing the right thing, actually. Hello? It doesn't mean you are doing the wrong thing. You are doing the right thing. But sometimes price can decide to have a mind of its own. But it is not every time that price will decide to have a mind of its own. It's just like saying, oh, the two of us, we are friends. We want to go somewhere, right? I hope you know that I might take that place we are going to, I might take it more serious than you. Which means that by the time that, oh, we want to leave by 2 p.m., by 2 p.m. sharp, I am ready, isn't it? You might not be ready at that point because you're not taking it as serious as you are taking the market much more serious. So the market will delay, but eventually it will still go. So that's why I'm saying that where you take your entry from is very important, because even though your timing is wrong, the consequence is that it gives you negative. That negative will not be much. It will still be within range, right? Are we together? It will still be within something that you can still bear, pending when price will eventually do what it is supposed to do, as long as you remain there. Just like my USD JPY trade I told you. And my Euro AUD was profit. All of a sudden, it came down to small negative. Then, before you know, even as we are speaking now, it's just going, right? So sometimes the market can, even if you take your trade at the right point, it might delay before going, which is a perfect scenario. But if you remain on this trade, didn't you eventually close profit? Right? You eventually close your profit, okay? So this is a. So what did I even say we want to do now? Candlesticks, right? Should we? Are there? Yes. Bullish engulfing, for instance. In a typical candlestick is what gives you that. Candlestick is what gives you the inside story of what price is doing as an like currently. The candlestick tells a story. The kind of candlestick that forms is important. There are certain things about candlestick. Number one is type of candlestick. One. And number two is the location of that candlestick. What type of candlestick formed? And where did it form? So we have type and location. A candlestick can form at a particular point. A candlestick can form. If it forms at a particular point, it has a meaning. So an average candlestick has 4 different points. 4 different points. So let's take this to be a candlestick. Usually, most often than not, candlestick has upper wick and lower wick. A candlestick has 4 different points. Number 1 point is we have the let's say we have the entire point of this is the body of the candle. The body. An average candlestick has 4 different reference points. Number 1 is the highest point of the candle, right? Which we call the high. The lowest point of the candle, which we call the what? The low. So it has a high and a low. Then a candlestick has an open price and it has a close price. High, low, open, and close. Meanwhile, there are 2 types of candlesticks in the market. This is one. There's another one like this. There is another candle like this. We have the high. What's the difference between this candle, and this candle? What's the difference? One is blue and one is red. First. Which one is bullish? Which one is bearish? Why? Okay. For the sake of those why. One of the candle, the major difference, if you notice, the high is still the high, the low is still the low, right? The major difference is the open and close. One opens below and closes above. The other one opens above and closes below. So the one that opens below and closes above means at the end of that particular period, price closed higher than it opened, right? Which is bullish. This one, at the end of the period, price closed lower than it opened, which is what? Bearish. Are we getting the idea? So, bullish and bearish candle. Now, let's now talk about different candlesticks, right? There are different candlesticks across board from all of this scenario now. Let's zoom in more. You notice that some candlesticks, the body of the candle is small, while the wicks are longer. You notice that? The body of the candle are small, while the wicks are longer. You can see example like this one. The body of the candle is smaller than the entire range. Abi? But you can see another one like this. The body of the candle is much more than the wicks and the high and the low, the wicks. Right? So there are different kinds of candle. Now, you see these candles that their bodies are smaller than the wick. They are very important candles. They show us what we call indecision in the markets. Indecision. They show us what? Indecision. Why? What do I mean? In the market, there are buyers and there are sellers. If the body of the candle is much more, covers more area than the entire range, like the wick, upper body and lower body, it shows that one of the party in the market, either buyer or seller, are dominant. Abi? Now, this is it bullish or bearish candle? This one. So, and this candle is a big one. The body is big. It means that buyers dominated this market as at, I'm on a 1 hour time frame. For 1 hour, buyers dominated that market. Are we together now? The second candle is also very much bullish, isn't it? Buyers dominated again, convincingly. Now, check this third candle here. You can see that the body is smaller now compared to the range, isn't it? It means that the momentum that buyers had with this and this, they have lost it here. The buyers in the market are now, first of all, the candle is small. Abi? The number of buyers in the market have reduced. Secondly, even though it closes green, a bullish candle, but the body is smaller, isn't it? Buyers have lost that market. There is indecision now. Neither buyers nor sellers can control the market like dominantly again. Now, imagine that I have been dominating a market before. I am no longer dominating the market again. It signals that I am losing ground, isn't it? And when buyers are losing ground, who will gain ground? What now happened after then? Are we seeing it? At least sellers now enter the market and they started entering small. Are we? You can see sellers started entering. This is showing presence of sellers, but not strong presence of sellers because, two, the candle is small. Now, let me tell you, I've told you type of candle now. Okay, candles like this, there are different types. I don't want to jump things. I'm trying to explain as fast as I can. You know, I said I have a principle, which is not how far, but what? I might cover a lot of things now, and you might not really understand too much. But if I cover a few things and you really understand, I think that's better. We can find another day to cover the rest. Okay. So, where are we? We're here, right? Now, this candle, this type of candle here, that formed here, a small body candle compared to the wicks is what we call a doji candle. This one, especially when the body of that candle is like around the middle, it looks like a cross. This kind of candle is called a doji candle. D-O-J-I, doji. D-O-J-I, a doji candle, right? I'm sure there are a lot of persons here that knows what I'm talking about right now. A doji candle. Now, this is type of candle. Then location now, location. Remember, there are two things we are looking at, right? Type and what? Now, if a doji candle is formed around a high or a low, it becomes important. In this case now, price has been pushing up for a while, right? Then a doji forms. A doji is signifying a possible reversal back to the downside. If a doji forms in between, it might not necessarily mean something significant. Are we together? It might not necessarily mean, but if it forms after price has gone up, you now see doji around a high. It is signaling a possible reversal. Are we together? And at the same time, if it forms around a low, after price has dropped, after price has dropped, been dropping, then you see this one is not a perfect doji. But the goal, just have the reference. What you are looking for is one, a candle that the body is smaller, way smaller compared to the range. Are we together now? The body of the candle is small compared to the range, right? So this is also a doji, but not a perfect doji, but it still qualifies, right? Now, and you can find it at a low, which signifies a what? It signifies what? Possible reversal. It's reversal. They signify reversal. Reversal to the opposite side of where price is coming from. Price has been coming from a high, dropping. You now see a doji. It's now telling you that sellers are beginning to lose that momentum of pushing price. After a doji, you should be expecting the presence of who? Abi? The next candle was a what? A buy candle. Sellers still try, still struggle, but buyers have now entered. This candle here, this is like a bullish engulfing candle now. A bullish engulfing candle or bearish engulfing candle is a candle that completely engulfs the previous candle, like the size. It covers at least 50%. I'm sorry, it covers at least 50% or more of the previous candle. You can see this one, right? So, bullish engulfing candle, signifying presence of buyers, right? So even when sellers try coming, you can see that the sellers candle were not large and they were having wicks. All of a sudden, the reversal now took effect. So sometimes price will, if it wants to go up, it will delay first. And that delay is because it's trying to gather momentum. And the momentum is what we call liquidity, which will do last, right? Which will do last, the liquidity. Please, any question based on the doji candle, bullish engulfing candle? There are plenty. There is a gravestone doji. There's gravestone doji. There's shooting star. There is maribozu. Then in that type of combination, there are 3 black crows, 3 white soldiers. There's morning star. There's evening star. There's a lot of candlesticks are just crazy. All right, so candlesticks normally should be an entire class on its own. Like if you want to do candlesticks now, I would prefer we have at least a 4-hour class, but broken into 2 hours that we'll do and go for break, because it is not just enough to know the candles. We need to do practicals. Are we together? Practical is what will help you to understand the market more than just theory. So let's just manage the one that we have talked about and continue, what we were doing before. So we stopped at Fibonacci. Now let me give you a scenario of bearish market. So when we are done, we'll apply Fibonacci. Some of you will come and apply the Fibonacci self. Bearish market, bearish structure. Everything we have done since is just bullish, only bullish. All right, so mention 2 candles that we just talked about now. Two candles that you can remember. Morning star. Why are you mentioning? Because I will not ask you to come and show me. You are mentioning the one I will not ask you to go. I wish I have showed you morning star. Where's morning star, Seth? This looks like a morning star. A morning star shows bullish reversal to the upside, right? Morning star is a combination of 3 different candles: bearish, bullish, and bullish. Bearish, this sell, this bullish, and the next bullish. So 3 candles together. This is not a perfect one. Good. This is more like a perfect morning star, but especially when the size of this one and this one, they are almost the same. Imagine this one now and this one, their size are like the same. Are we together? So it can form something like a morning star for us. So it shows a strong bullish reversal. Okay. Yeah. You have any other one? Okay, yes. The only problem is they need something smaller in between. It has to be like one will be big, there will be small in between, and the other will be big. The second candle, which is in between them, will be the smallest candle. Like something like this. You have this one. You have the smaller one. Especially the smaller one. And you have another bigger one. I'm sure you understand me. So the combination of these 3. So we have, if it's found after price has dropped, if it's found location at a low, after price has dropped, is a bullish reversal. If it is found above, after price has gone up, and you see that combination up, it's a bearish reversal. This one is called evening star now, not morning star. The bearish reversal of it is the evening star, not morning star. Don't worry, we'll look for time where we'll talk about candlestick. We'll really digest candlestick. We'll start from the origin of candlesticks. With this one? Now, when you start talking about stop loss is based on your position size, if you want to stay, you're a scalper or you're a day trader. And if some people have a principle of a fixed stop loss, which is if I enter now, my stop loss is always 10 pips, 20 pips, 25, you understand? So stop loss is a subjective matter. My stop loss is based on the structure that I'm seeing. I usually put my stop loss around the previous low. The previous low. So in this scenario now, where was the previous low? This was the low. This is the high, right? Are we together? So if I'm taking my trade anywhere around here, I will prefer my stop loss to be around this previous low. So you see that I didn't get it. It didn't hit my stop loss. Because there's a possibility that price can come and do 100% retracement before going. So if my stop loss is anywhere inside of this level, before 100%, price can take my stop loss, but still go my direction, which I don't want. So an ideal point of stop loss. But there are some kind of lot size that you use. To put your stop loss here, it will be too much. Imagine trading this market now, you're using 10 standard lots. Here is it JPY. Price move 20 pips against you alone. That will be how much? That is like $2,000. $2,000 straight. That's $100 per pip. 10 pips will be $1,000. 20 pips is $2,000. How many of you have that kind of money to play around with? Just say, I just want to test something. So, but if you use something like 0.1, which is around $1 per pip, right? You can put your stop loss outside of here, even if the stop loss will bring you at 30 pips. That will be around what? $30, Abi? Then, the distance between where you put your entry from here and here, you notice that is either equal to 1:1 or even more than 1 ratio of your, you make slightly more than your stop loss. This should almost give you about almost $40, right? Compared to your $30 that you are risking. And if you now happen to take the trade around this low, you risk less than $30 and you probably make even above $50 even from that setup. Are we together now? So it depends on how it forms. So the ideal stop loss should be below the previous low when you're taking a setup like this, right? So this is Fibonacci. Then let's see a bearish structure. Or I need somebody to come help with this stuff now. Okay, so look at this market. Say this is our low, right? Should this be our high? This is low. Should this be our high? I like moments like this where everybody will be quiet. Some people will be assuming, be forming like they are thinking. Let me tell you, only 3% of the people in this world are thinking. The rest of us, we think we are thinking, but we are not thinking. So I know you are not thinking right now. In fact, you are more confused. Look at this thing very well. Use reference of what is not retracement to judge this market. This is your low. Say we are in a bullish structure. We are trying to attempt a bullish structure. This is your low. Where is your high? You can come and help us with your high. No, nobody. There's no wrong answer here. Please, there's no wrong answer. Your answer is your opinion. Abi? It's your opinion. Please, no wrong answer. But your opinion might be wrong. Okay. If this is your low, where will be your high? Okay, this level, right? Yes. Why is this not your high? Because here is small. Structure right now, right? Given that this is your low, from what you are seeing, should this qualify as your high? Let's judge. Let's use our Fibonacci to measure if the retracement was up to 50%. From the lowest point to the highest, I'm looking for a bullish structure. Now let's look at this. So we have this, excuse me, because we've had a change of character here. So we are currently in a bullish structure. So we have this. This is our low. And this is our high. This is our high. We're on a 1 hour time frame. This sharp drop from this low to this high, this drop, was it up to 50%? It's not, obviously. Looking at it alone, right? Looking at it alone, right? That means we still continue, isn't it? 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 In a lower time frame. Now, this our retracement is giving us bearish structure. Bearish structure. So, which is high, low, lower high, lower low, lower high, lower low, lower high, and it has created another lower low, right? So, the last major high that we've had, if price can invalidate this level, meaning going above it, so from here, say price continues pushing and it goes above this particular level, it means that we'll have a change of character. All we need to do is to wait for a retracement into discount. I mean, use Fibonacci to capture the retracement for us to keep pushing higher all the way to this point. Is there anybody that's confused about what I did now? Okay.
You're trying to say, you said this is not a downward trend, retracement.
This is still retracement, yes. Everything that is happening is still retracement. The problem now is that I hope when I say if you don't pay attention to what the market is doing and try to follow the market. Now, who is going to be a good student? A good student that the teacher loves, that the teacher will help, is the one that comes to the teacher always to come and learn, Abi? You learn, you understand. But the one you don't really understand is you find yourself in bad situations. So see a scenario. If you are taking this point, if you are taking this point as, you are taking this retracement now, and you are using this point as your new low and this point as your new high, the error came first by considering this to be a good enough retracement from this low. That's where the error started. You will have an error. It's just like, there's a particular saying in my this and that, you put, there's fire on your roof and you went to sleep. Know that adage? Nobody puts fire on the roof and goes to sleep. I mean, you can temporarily enjoy that sleep, but it's just a matter of time before it will catch up. So you have considered this point as a good enough retracement, which is the first error. Now, you now say this is your low, this is your high. Retracement, it gives you like 50%, you buy. You are making profit, Abi? Now, this is now your low, this is your high. Retracement, 50%, you buy. You are making profit. This is your low, this is your high. It will not get to a point where you now consider this as, this is your low, this is your high. You are now trying to buy. Price is no longer buying. Abi? Negative. You are still trying to look for buy. Price is not buying. Negative. Abi? You are still trying to look for buy. Price is not buying. Negative, isn't it? So you will definitely get to a point where you'll be hitting the negative streak. But our knowledge of what is not a retracement now has helped us. So what will it help you to do? It will help you not to be taking those trades that you ought to have been taking. You will not fall into those traps. You will now see the reason why you shouldn't have been taking those trades, because price has been forcing itself all the way down. Now, you will now enjoy it much more, because all the while you were not trading, So when price now resume going up, imagine this distance that price has covered. Imagine this distance from this low to this high. Hope you know that when price starts going higher and higher and higher now, it will go for a long time. It will go for days, isn't it? You can swing it, you can day trade it for days, which means always looking for buys, isn't it? So you will now enter another winning streak again, because you understand the directional bias now. Market structure has given you that idea to filter the noise and help you to understand what price is trying to do. So if you don't have good idea, there will always be problem.
So, but this thing will be very frustrating, because this is 1 hour. So, if you look at those candles, that's like how many days you are doing nothing.
This is like, okay, from here, it took 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 days at least. which is like almost 3 weeks. Yes. Now, you couldn't have been selling because you don't know when the retracement will start. But I can assure you that it's going to be worth it. Now, basically, what I do is I will leave this instrument and I'll go and look for another one. There are at least 28 major currency pairs, so just choose another one. See, if you understand market structure very well, and you have maybe even if it's Fibonacci or moving average or whatever strategy you are using, if you are using other blocks, whatever, to trade, you can trade any of these 28 major currency pairs, any of them. The differences between them might just be slight. Some have smooth and calm trend. Some have rough trend. If you can still navigate your way around the rough trend, it's good. If you feel you cannot navigate your way, stick with instrument with smooth and calm trend. USJPY has smooth and calm trend. Euro JPY has smooth and calm trend. CHF JPY has smooth and calm. In fact, major currencies with JPY have smooth and calm trends. So I prefer them. Are you getting the idea? They have smooth and calm trend. Go and trade those ones. Leave the likes of Euro USD, GBP USD, because those ones, they are very rugged. It's just like Barcelona and Real Madrid play match now. You know, you cannot predict the winner from the start. It's hard to predict the winner. You watch ball? You will not understand. You will not really understand. What can I use now to let the ladies understand? Whew, what's the time now? No break. Are we not supposed to go on break, come back and finish, or just one straight class? One straight class. I can see smoke coming out from some people's head. I'm beginning to pity them. Okay, any question? Let's now go into the last session. There's question? Excuse me. Okay. So for those of you online that would like to join our WhatsApp, also register with us. So you can simply send group to, I'm sure it's been dropped on the, just send group to 080 or 234, because we have some international audience also. 234 80 6173 9229. 234 80 6173 9229. I call it for the last time so that I can take it down, because some persons would like to join our classes. We would also like to trade with us. So for you to be able to do that, just send group, 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 to this number, 234 80 6173 9229. So once you do that, automatically you'll be added, right? Automatically you'll be added. So we can have classes together, and you can also register so you can join our live trade sessions. Now let's go to the last straw we had. Unfortunately, the way I planned the class to be is not how it's playing out, but it's not bad. By now, we should have been done with market structure, because we still need to do internal and external. So this is external, your swing high and your swing low. Remember, your external, right? Then everything inside is your what? Internal. And your internal is where you have your retracement. And all these retracements, they are accumulating to what we call your liquidity. How does betting work? Betting. Can you bet and win money if there's no money involved? The more the people that bet, the more money involved, Abi? Although I don't play bet and but I understand. Without money, can a buyer buy? Without money, a buyer cannot buy. And if a buyer does not have money, a seller will not sell. So In other words, transactions cannot take place if there is no liquidity. And liquidity is the ability to buy and the ability to buy and willingness to sell. Why am I willing to sell? It's because there's money involved. Why can I buy? Because I have what will make my demand effective, which is money, right? So, let's say, for instance, I have 10 billion naira. I want to convert my 10 billion naira to dollars, right? How will I do it? Physically speaking, I'll need to go to bureau de change, isn't it? Like, I'm not using any exchange now. Like, physically, let me just give you a background understanding. I will need to take my 10 billion to bureau de change, maybe zone 4 and all those places. Now, if I carry 10 billion, that person has like $50,000, which is still insignificant to what I need. He will call another person to add. Maybe the two of them can have like $80,000 or $100,000. By the time you join 10 of them, maybe I have like $1 million. I have like $1 million. By the time you have 20 of them, Abi, we are getting, sorry, by the time you join like 10 of them, I'm having almost $500,000 in exchange for it. So if you gather most of them in that particular day, I might be able to convert, let's say, 3 to 4 billion to dollars, which means I still have 6 or 7 billion to go, isn't it? So the more sellers come to the market, it creates much more liquidity that I will use to buy more. My buy will now be much more effective. Are you getting this idea? If you get it, say yes. If you don't, say no. No here. Please, the online spiritual people. If you get it, just put a yes. And if you don't get it, put a no so that I can recap or probably explain another way. I'm just trying to give you, to wrap your brain around it before we now proceed on how it looks like on the chart. We will see the stop count loss. They don't get it. Is it that my mic is not audible? Okay. I think I'm being. My explanation is more to the naira side. I think, is it that some persons cannot relate to the naira to dollar? If you go to the market around 11 a.m. to between 3-4 p.m., I think you find a lot of persons, right? You find a lot of buyers and you find a lot of sellers. Now imagine that you now go to the market. You know this popular thing that we used to do when there's a wedding. There's always this ashebi, abi. You need ashebi, like at least you need like 1,500 pieces. You didn't go to the market when the sellers were there. You went to the market around 6:30 p.m. You will hardly find much sellers, right? Good. But if you go to the market around peak, and guess what? Because maybe you found 1 or 2 sellers, the sellers are at the advantage now. They can sell to you at whatever price they want. And you have no choice because that is the only seller, or those are the only 2 sellers available. But if you allow much more sellers to be in the market, first of all, the 2 sellers that were there might not be able to give you enough quantity that you want, right? But if you go where there are a lot of sellers now, first, it's guaranteed that you will have all the quantity you want. Because there can be about 20 to 50 sellers available to you, isn't it? You can execute your transaction faster, easier at that point now. And guess what? Not only that, you can even possibly have a good bargain to buy it at the lowest possible price. So, these are buyers. Buyers have the upper hand. Buyers are more in the market. And when buyers are more than sellers, price will tend to do what? To go to the upside. Isn't it? All the way here, sellers are not interested in the market because sellers don't like to sell when price is low. They only want to sell when price is what? At a particular point now, when sellers feel that price is high enough, that is when they will now come in, isn't it? At that point, buyers will feel, okay, look, this thing is becoming too expensive. I gave an analogy that I want to convert my 10 billion naira into dollars, which should give me almost about 6.7 billion and $7 million. All right, if I'm right. Yes. It should be roughly around $7 million. That should give me this 10 billion. Now, there is no way the available sellers at that point will be able to fulfill all my orders at once, isn't it? Because I have volume. That is where we are trending. That is what the trend looks like. Our trend is an uptrend. We have more buyers in this market than sellers usually. So when buyers have completely absorbed all the sales available, that means I got there were about 50 guys that were converting dollars, bureau de change now. I bought from all 50 of them, but I was only able to convert. I need my 10 billion, I was only able to convert like 4 billion at that time. Less than $3 million. And I need $7 million. I don't know if you understand. So I was able to convert $4 billion. I have absorbed all the sellers. Sellers have given way for me. There's no seller again that I can buy from. So at that point, I will need to give way for the market. Meanwhile, I am buying from 1.5. All my buy now move price much more expensive to 1.7 per dollar. So naturally, as a buyer, I will stop at that point because I don't want to buy the first set at 1.5 and come and buy the next set at 1.7. It will not be profitable for me. So what will I do? I will then allow, meanwhile, all these things I've done, I've absorbed all the current sellers. It will attract new sellers to the market because price is now expensive. So you will now notice that sellers will now jump into this market, jump into this market, jump into this market for me. From here to here, the amount of sellers that were here will convert, let's say, 2 billion for me. And I have 6 billion to go. I will allow more sellers to come into the market. This one from here to here will convert another 2 billion for me. I have 2 billion to go. I will wait for much more sellers to come so that I will have enough what? The more sellers that I have in this market, the more it will be easy for me to convert all my orders and execute. Two things. Because there are plenty sellers now in the market, I can get a cheaper price. Abi? I can get a cheaper price, I can bargain. So price will most likely be lower. Then, because there are plenty sellers, there's a very high tendency that I will have enough product that I need. The quantity that I need will be available there. So price will even move much more faster. So all of this is creating liquidity. So when price moved from swing low and it kept going up, you know price is becoming expensive, right? When price gets to a particular point, it is now very high. Sellers will jump in now, isn't it? And start creating that liquidity that I need for me. So I need to allow sellers to come into the market. The more sellers I have, the more it will be good for me in the future when I want to come and buy. Abi? Now, every low that sellers create for me is a liquidity area. There are 3 types, but if we can consume 2 types of liquidity very fast, we'll brush them again the next time. It will be good. We have what we call equal highs and equal low liquidity. Equal highs and equal low liquidity. Equal highs and equal low liquidity. Sorry. So you asked a question the other time. Please, can you recap it? That stop hunt or something?
I was saying, yes, so it means that the big players, just because of the large volume they have, not necessarily that they are looking for retailers to clear their stop loss points.
So you will see, price goes this way. Then it does one small retracement first, and it goes up again. Now you see this place that it did. You know, it has brought sellers here. It has brought sellers here. Then around this low, there's liquidity. If price comes back to this point, I hope you know that some persons we want to buy from here, Abi. Hello? When you are buying at a low, or let me even put it that equal low, because this will create inducements to bring you to. So I have this level here, and it is seen as support. Price comes back to this point here. Now, what do you want to do? Most people will be looking out to buy, isn't it? Especially when we are bullish. Abi? This is more like a support area. Are we together? Now, when you buy, you place a buy order. Your stop loss. So you are buying from this point. If you buy, you put your stop loss, right? Below the low, isn't it? Let's say you put your stop loss around here. Your stop loss. This is your buy. This is your stop loss. I hope you know that the opposite of this your buy, your stop loss, is the opposite of your buy. Which is a what? Is a sell. I want to buy something at $100, hoping that the price will go up, and I want to sell at 200, Abi? But all of a sudden, so because if you buy, your take profit is a sell. And all of a sudden, the thing did not buy, it went, current price was at 100, it went all the way to, let's say, 70. I decided that, look, I'm not doing again. For me to now get out of the market, I need to sell, isn't it? I will sell at 70. Did I make a profit or loss? You made a loss. You're buying at 100, right? So, if you place a buy order, your stop loss is the direct opposite of your buy, which is a sell. And for price to buy, for buy to happen, who do you need? So, for this my buy to be effective, I will need to look for as many sales as possible. Sell orders. Both stop loss, and you know some people will put breakouts, sell stop, penny order. Sell stop, penny order. Is also sell. Anything sell. As even stop loss or whatever is below your buy order, especially slightly below the low. So what will happen is you will see price now do something like this and eventually go your way. All right? Around, carry your money. As me and right. Now, this is a low here, created an internal liquidity. You can just do it a one-time thing. So much so that price will now come lower because some people that don't really understand the way the market works will be trying to buy around this area when price comes here, right? They will be placing their buy order. And when they place their buy order here, will the market stop here? It will go
lower because they will put a lot of stop loss, a lot of sell limit, a lot of sell stop, hoping that in case price wants to break and everything. And when price finally picks them, it will now their money will just disappear. But it will appear in someone else's pocket.
Your screen.
Huh?
Your screen.
Okay. So liquidity is very funny. And it's very interesting. Liquidity actually is the money game of the market. It's where it becomes a game now. It's just like saying, have you played hide and seek before? Hide and seek. We are all in a big house. The market is like a big house. All we are doing is we are hunting for what? Liquidity. Remember I tell you that liquidity is what makes transactions happen, right? So whatever we are doing in the market, we need liquidity. If I'm to buy, liquidity has to be there. If I'm to sell, liquidity what? Has to be there. So it's a game of who understands this business more. If you can get half of liquidity, combined with the market structure, you just be packing the money anyhow from the market. But why some people are not packing the money is because they lack one more strategy, which is patience. Patience is a strategy, and guess what? It's like the most important strategy in this market. If you understand technicals and you don't have patience, you will still struggle. You will still struggle. You will still struggle. This is one form that this liquidity can happen. Then, another way is this. Price gives us, after an impulse, it gives us a retracement that is even 50% and below. I mean, you know this is what we want. Then price goes up again. A little bit. You know that a lot of these persons will already be getting ready for buy. I mean, now, but you know that people will be getting ready for buy. Buys will be here. But if price comes down, so meanwhile, here that it has created liquidity here, isn't it? What if price now comes down to this particular point? Hope you know that much more buyers will jump in to the market, have you? But what will make their buys successful is that as they are jumping in for buy, they are placing their order here, which is the right thing to do, but their stop loss is where? Down here, right? So sometimes you find out that the market will just and still. Hello? Are you getting it? Let's try to look for scenarios like that on the chart. Let's look for scenarios like this on the chart. Okay, good. So remember from this swing low to this swing high that we have here. Let me take this one out. This swing low all the way to this swing high. So, but you notice one thing. You notice that the first time price was coming down, giving us some good retracement, it got to this point. Notice that it came to this point again, I mean, which is we would have been preparing some sweet buys. We would have been preparing some sweet buys around this level right here. Around this level right here. Now, why do you think price now went slightly below this level before finally going to the upside? What do you think price is looking for? Liquidity. What price wants to do is to go from this low to go and create another high. I mean, that's what he wants to do, is what he's attempting. But the way he decides to do it now is what will bamboozle a lot of people out of the market. It's just like saying that if price gets enough liquidity here, if he gets it early, price would have gone earlier, because there are times where price just get liquidity and it has gone, right? So imagine that you want to travel. You are moving from Abuja, you want to go to Lagos. Please, as you are going with your car, there's something that must carry you, there's something that you need for that your car to move from Abuja to Lagos? What's that? You need fuel, to sponsor that journey. That is your liquidity, isn't it? Good. Now, imagine that you attempted going on that journey after getting here. You now want to go. You now discover that, my fuel is not enough, What will you do? Will you continue that journey? What will you do? You come back to look for what? To fuel. So price is looking for fuel. The earlier it finds fuel, and not just fuel, the earlier it finds enough fuel that it thinks will be able to sponsor him for that journey, that is when you now embark on that journey. So that is like the story of what price is trying to do here. So it is looking for something. It's looking for liquidity. Meanwhile, what he wants to do is to buy. Who is he looking for? Seller. So it feels that at this point there is not enough sellers yet in the market. So it will stay there. It will stay there. Yes. It will stay there. Alright? And price attempted it like this. You know you have placed your stop loss below here, right? What did price do? He came to pick all the stop loss, but the stop losses he picked was not enough. It attempted, look at how he picked it and quickly did like wanted to go up. It's not enough, it's not enough. Maybe you were thinking that you will stop at Lokoja and I say, no, you go all the way to Lagos. This will not be enough. What will you do? He came back again. Picked stop loss here. Not enough. Picked some again. Still not enough, and picked more, and look at how fast. Just 1, 2, 3, 4 bullish candles gave us some massive distance. Price does this a lot. Have you entered trade of this kind of scenario and you put your stop loss? The thing carry your stop loss. Has it happened to you before? If it has happened to you before, let me know. Okay, yes, let us know. You are trading. So has it happened to you before? The thing will just disappear. I know when price hits your stop loss, it's like magic happened. In your very before, the thing will just disappear. You'll be looking for your money, you will know. That's what they call OT. Has gone. Massively gone, right? Another scenario. I'm looking for bullish structure before we now start bearish structure. Okay, so we have this particular move right here, from this low to this high. It gave us this retracement is at least 50% now, from here to here, right? Notice that it came back to this point. What is it looking for? Now, I hope you know that once price did this, it could have as well gone to create a new high. But what makes price to come back? Just know that as it's coming back, what is it looking for? Liquidity. And which is price, since you know that we are in a bullish market, right? Price wants to buy. So you know that it means what? Sellers. Isn't it? And where will people be more interested to buy? Or where will you? So the technique is that look for where people are interested to buy and look for where they will possibly put their stop, because their stop loss is what you need. It's a sell order, isn't it? Because people will not want to sell. Everybody is looking at buy. But the problem is that buy that you are looking for, what will sponsor the buy is what? Liquidity. So you need to find where liquidity. So liquidity rests below this low. You will find liquidity there. They will put liquidity there. Right? So it comes to this point here. Not breaking above this high. This high and this low. Price not breaking above this high is telling you that there is not enough liquidity for price to sponsor a new high. So price started to do what? Come back. Just be waiting for it to get to this place Wait for it to even possibly go slightly below. Yes, that's a sweep of liquidity. This one did not really sweep liquidity. It just packed the liquidity here and sponsored a new high. Now, since we have a new high, that means we have a new low, right? Where will our new low be? In this case now, where will our new low be? We have a new high. Where will our new low be? Just come and show us. Just come and show us. Okay. Where will our new low be? Please. Don't worry. Yes, that's the new high. So where will our new low be? Okay. You know we are doing high, low, high, low. This was the previous low. This, the previous high. Price has given us that retracement, right? And it has gone to create a new high. So where will our new low be? Okay. Just help us stand like this. Now, this is the new high, right? The low is the lowest point. Okay, you are blocking some persons. The low is the lowest point of the retracement before you now have a new high. So this is the lowest point of the retracement, this point here, before we had this new high. So this is going to be your new low, while this is going to be your new high. We can't take this as our low. This is, you will notice that we can't take this as our low because you will find out that this is internal. Something like this. Let me mark the new high. This is the new low. And this is the new high. This is the new high, this is the new high. You find out this low is internal, this low is internal, this low is internal. Right? So now, this is the next scenario I want to paint out. Price is doing retracement, isn't it? And we now need to go to the upside. It has given us at least 50%, if not a little bit more, right? Now, price needs to go up. It couldn't go. It's coming back down. What's it looking for? Where can we find liquidity? We have here, right? Which means there's a very high tendency that price can come below this level, isn't it? Now, which price obviously did come way below, sweep all the stop losses below that when you place your buy here, that you have placed, have it, before finally. Are you getting the idea now? This is where that last ingredient that I'm talking about will help you, which is patience. Right? You can go. Thank you. Don't worry, I'll give you the one that you know. Okay. And guess what? I was even thinking if she gets it here, maybe she'll get it today. Maybe the next one she'll get it. The next one. Right? Please, are we following? Because those are some people said are already hot. Smoke is coming out from some people's head. So let me do a recap for us. Let's call it a day because we have just 3 minutes. We have just 3 minutes, right? So let me ask a couple of questions. So in doing your structure, what are the 2 most important points in your structure? The 2 most important points in your structure. Yeah, I forgot. You are supposed to be chorusing this thing like this.
Swing low and swing high.
2 most important points in doing your structure.
Swing low and swing high.
Are you sure?
Low and high.
Ma? Police and bearish? You people are even trying more than me that year. I remember math teacher, Mrs. Magaji, will come and shout, "What is the area of a parallelogram?" I'll just be looking like this. Like, what is this one I'm talking about? Why others will be busy chorusing the answer? You know those children that used to wear glasses in class? Very dangerous people. They used to know people. The two most important points in our structure are our swing points, which is your swing high and your swing low. Your external swing high, your external swing low. They are the ones that will tell you if your trend is still in line or your trend has been violated. Right? Your internal is not as much important as your external, but your internal is what will give you your entry price. Are we together? Now, if I ask this question now, you will just get the answer. You will get the answer. An ideal retracement should cover how many percent?
50%.
Is it just 50%?
At least 50%.
50% or more, right? An ideal retracement. Okay. What else? Any other question? Any other question? We'll call it a day for today, but this is what we'll do. This is what we'll do. In the next class, maybe myself or my other self, we'll dwell more on this liquidity, right? We'll dwell more on liquidity. Because if you can combine your structure and liquidity, it's going to be of great help. Trust me, your trading game is going to change massively. Massively. This is where you now start doing some dangerous things. There are some guys that will turn like dangerous things when it comes to timing of the market, right? There are different ways to trade. There are times where, mostly, if I don't have time, I'll decide, okay, this trade, I want to swing it. Let me just place it and leave it. And in that case, I'm ready to hold on to some amount of negative in case price does not have enough liquidity and it wants to come back to grab more. Because I know eventually, grab all your liquidity then. So in that case, no matter the liquidity you want to grab, you cannot come and grab liquidity outside of this place again. Because what made you to break here will give us a change of character. We are no longer in an traffic. So my stop loss will be here. Play all you need to play inside here. When you are done, then you will go. Are we together now? But if you have small accounts and you want to grow that small account very fast, you must understand all of these things. That your small $100, you can turn it into $200, $300 in a day. One move. Because you understand what market is doing, especially when price has attempted to go, failed, and comes back. You will not enter first though. Let others enter. Those are the liquidity. They say if you don't know where liquidity is, you will become the liquidity. Let them enter and become liquidity for you. So you wait. When you see that price has violated or sweep everything and you will now enter the market now. Two things, you will hardly see drawdown. Like you won't stay, your drawdown can be in seconds or few minutes before you know you are going, right? And after going, price might not necessarily look back quick. You know, you enter with a small account now, $100, and you're in profit of like 20. You know, sometimes that your 20 can come back to like 5, possibly even bring you to negative, right? Before it will start going again. What most of the time, if you get that kind of thing, it can take you to like $30 profit quickly with a small account. Then that 30 can maybe drop to like 10 or 15 highest. It will continue again. So it won't hardly bring you back to negative. I don't know if you are getting my point. So this is how, if you want to grow small accounts, you need to understand all of these things. And mostly, you are going to be mostly a scalper. Mostly a scalper. That's why scalpers are the ones that pay attention mostly to this. If you are a swing trader, yes, understand liquidity, but even if you don't understand liquidity, as long as you have money and you have patience, you still make money in the market. Right? So, please, if you have questions on I just drop it, we'll do it to answer. I'm seeing some supply and demand. Oh, yeah. But I'm not completed now. I'm only seeing demand, there's no supply. I told you if I clean it, most of you will not be able to draw it. And in case you're online, you draw your own. You submit it next class. Alright? So, no question? Thank you very much for your time. I hope you have learned something today. Please do well to join using the phone number. I think it has been posted on the...
Yeah, right? But you can still like call the phone.
Alright, please. I think the number is 234-80-6173-9229. Right? Just text group GROUP to this number 23480 6173 9229. I called the number for the last time. Just text group GROP to 23480 6173 9229. So you can be a part of our class, you can register, you can even register or just fund your account to do live training together. So when next we're having class, you'll be notified and we can have class together, alright? Thank you very much for your time today. Looking forward to seeing you in the next class, right? In the absence of any other question, enjoy the rest of your day. So, any question for us? See something is happening here. And if we've had a change of character now, we would have said that, you see this low here, hope you know there's liquidity here now. Now, price attempted going to take out this high, it can't, it's coming back down. What do you think wants to happen? He wants to come and take liquidity from here, isn't it? Now, by taking liquidity here, it needs to come parallel or even below, isn't it? When it can come below, if it successfully comes below, good. When it start going up, maybe you now see that you're bullish engulfing, or you see your morning star, or you see that doji below, or even hammer, you can start firing down. Your stop loss will not even be that far. Start fire. That's what we call fire. Sorry, let me not be emotional about this. Alright. Okay. I think you used to do this thing. Yeah. You used to fire down. Yeah, you turn $100 to 1,000. Sniper. Is this how you do it? Yeah, actually, that's how Don't forget your assignment of Fibonacci. I will ask you.